Welcome to the CPA Lease Accounting Quick Review. Today we're focusing on the most heavily tested lease concepts for the exam. The goal is not to teach every detail of leases. The goal is to help you remember the concepts, formulas, and traps most likely to appear in multiple choice questions and task-based simulations. Remember, lease accounting becomes much easier when you realize that most questions revolve around four things: classification, measurement, expense recognition, and presentation. Part 1, the big picture. Before we get into the details, let's start with the foundation of the entire lease chapter. Every lease starts with two accounts, a lease liability and a right-of-use asset, often called the ROU asset. The lease liability equals the present value of lease payments. The right-of-use asset generally equals the lease liability, plus or minus certain adjustments. If you remember this, you are in good shape. The CPA exam loves asking questions about what belongs in lease payments, what discount rate to use, and how to classify the lease. Everything eventually flows back to the lease liability and the right-of-use asset. Part 2, finance lease versus operating lease. This is the most important lease topic on the exam. The CPA exam constantly asks whether a lease is a finance lease or an operating lease. Remember the finance lease criteria using the word own as. If any of these criteria are met, the lease is classified as a finance lease. O stands for ownership transfers. W stands for written purchase option, also called a bargain purchase option. N stands for lease term, representing a major part of the asset's remaining life of 75% or more. E stands for present value of lease payments, representing substantially all of the asset's fair value, which is 90% or more of fair value. S stands for specialized asset. If any one of those criteria is met, classify the lease as a finance lease. If none of them are met, classify the lease as an operating lease. Now let's talk about the memory trick that makes this entire chapter easier. Operating equals smooth. Finance equals front-loaded. Operating leases produce a relatively even expense pattern throughout the lease term. Finance leases produce higher expense in the early years and lower expense in the later years. That single concept solves a surprising number of exam questions. Part 3, initial measurement. Now let's calculate the lease. The exam often tests a 5-step process. Step 1 is determining the lease term. Step 2 is determining which lease payments are included. Step 3 is determining the discount rate. Step 4 is calculating the lease liability. Step 5 is calculating the right-of-use asset. Everything begins with the lease term. The lease term includes the non-cancelable period. It also includes extension options if the lessee is reasonably certain to exercise them. It includes termination options if the lessee is reasonably certain to terminate the lease. The phrase reasonably certain is heavily tested. Whenever you see a purchase option, extension option, or termination provision, ask yourself one question. Is it reasonably certain? If yes, include it. If no, exclude it. Part 4, lease payments included versus excluded. This is probably the most tested lease calculation topic. The CPA exam loves asking which payments belong in the lease liability calculation. Included lease payments generally consist of fixed payments, purchase options that are reasonably certain to be exercised, guaranteed residual values expected to be paid, termination penalties when reasonably certain to occur, and index-based payments such as CPI-based payments. Now let's discuss what is excluded. Variable payments based on usage or performance are excluded. Maintenance costs, insurance, property taxes, and most non-lease components are excluded. A simple memory trick is this. Included equals predictable payments. Excluded equals uncertain payments. Remember, maintenance is an expense, not lease liability. Part 5, discount rate and present value. After identifying lease payments, the next step is determining the discount rate. The rule is simple. Use the rate implicit in the lease if it is known. If the implicit rate is not known, use the lessee's incremental borrowing rate. The lease liability equals the present value of included lease payments. The CPA exam may provide present value tables, present value factors, or calculator outputs. You need to identify whether payments occur at the beginning or end of the period. If payments occur at the beginning of the period, use an annuity due concept. If payments occur at the end of the period, use an ordinary annuity concept. This leads us directly into one of the biggest lease traps. Part 6. The beginning of year payment trap. This is one of the most heavily tested lease tricks. When payments occur at the beginning of the year, the first payment immediately reduces the lease liability. No interest accrues before that first payment. Remember, beginning of period payment equals no first-year interest before the first payment. Students frequently calculate interest too early. The lease liability must first be reduced by the payment. Only after that does interest begin accumulating. Whenever you see the words beginning of year, beginning of period, or annuity due, slow down and think carefully. The exam loves this trap. Part 7. Finance lease, accounting. Let's focus on finance leases. A finance lease behaves much like purchasing an asset using debt. At commencement, record a debit to the right-of-use asset and a credit to the lease liability. After commencement, two expenses are recognized: interest expense and amortization expense. Interest expense is calculated using the effective interest method. Take the beginning lease liability and multiply it by the interest rate. Amortization expense is generally straight line. The result is two separate expenses on the income statement. Because interest expense is highest in the early years, total expense is also highest in the early years. This creates the front-loaded expense pattern. Remember, finance lease equals two expenses: interest expense plus amortization expense. Finance lease equals front-loaded expense. Part 8. Operating lease accounting. Let's look at operating leases. The journal entry at commencement is still very similar. Debit right-of-use asset and credit lease liability. The balance sheet looks very similar to a finance lease. The difference occurs after commencement. Operating leases report a single lease expense. One expense, not two. The lease expense is generally recognized on a straight line basis. This creates a smooth expense pattern. Now here's the trap. Interest still exists internally. Amortization still exists internally. However, the financial statements do not separately report them. Instead, they are combined into one lease expense. Remember, operating lease equals one smooth expense. Finance lease equals two expenses and front-loaded expenses. If you remember that distinction, most lease questions become much easier. Part 9. Financial statement presentation. Let's move to the presentation. Both lease types create a right-of-use asset. Both lease types create a lease liability. The lease liability is split into current and long-term portions, just like regular debt. Do not overthink it. Current portion equals the amount due within 1 year. Long-term portion equals everything else. Now let's discuss the statement of cash flows. Operating lease payments are classified as operating activities. Finance lease payments are split. The interest portion is operating. The principal portion is financing. A useful memory trick is this: finance lease behaves like debt. Principal equals financing. Interest equals operating. The exam tests this repeatedly. Part 10. Amortization period trap. Another heavily tested trap involves the amortization period for the right-of-use asset. For finance leases, ask yourself, does ownership transfer, or is there a purchase option that will likely be exercised? If yes, amortize over useful life. If not, amortize over the shorter of the useful life or lease term. For operating leases, the right-of-use asset is effectively amortized over the lease term. Part 11. Most tested exam traps. Let's review the traps one final time. Trap number 1 is including maintenance, insurance, or property taxes in lease payments. These are excluded because they are expensed. Trap number 2 is using the wrong discount rate. Always use the implicit rate if known. Otherwise, use the incremental borrowing rate. Trap number 3 is forgetting the reasonably certain rule. This applies to purchase options, extensions, and termination provisions. Trap number 4 is calculating interest before the first payment when payments occur at the beginning of the period. Trap number 5 is mixing up finance and operating leases. Remember, operating equals smooth. Finance equals front-loaded. Trap number 6 is using the wrong amortization period. Finance may use useful life if ownership transfer and purchase options will likely be exercised. Operating uses lease terms. Part 12. Final exam day review. Before we finish, let's review the most important lease concepts one final time. Lease liability equals present value of lease payments. Right of use asset equals lease liability plus adjustments. Use the implicit rate if known. Otherwise, use the incremental borrowing rate. Include fixed payments, reasonably certain purchase options, guaranteed residual values, and termination penalties. Exclude maintenance, insurance, property taxes, and most variable payments. Finance lease criteria can be remembered using owns. If any finance lease criterion is met, classify as finance. Otherwise, classify as operating. Finance lease cash flows are split between operating and financing. Operating lease cash flows are operating. Good luck on exam day.